Welcome to the Chiro Money Show, where we help chiropractors make better financial decisions so they can build stability in their finances and a lifestyle they love. We're your hosts, Chris Shield and Scott Campbell with Align Well. Welcome in.
Welcome to the show. How are we doing today, Chris?
Doing good. Doing good.
Kids are back to school?
Yeah, back to school, back to routines, all that good stuff. You got a good routine or a good task added to your routine, I hear?
Yes. Before the show, I was telling Chris that an added responsibility to my week is now taking care of my daughter's Tamagotchi that I got for her for Christmas. She's got it covered for the weekends, mornings, evenings, but when she gets packed into the car for school, it gets passed off to me for the day.
Nice. Be careful what you gift your children, people.
It's a good lesson for sure.
Good lesson. But that's not what we're talking about today.
We could probably have a podcast on that topic.
No. You're not parenting experts. We're not going there.
All right. So what are we talking about today, Chris?
So we are going to talk about how to crash proof your investment portfolio.
Kind of a catchy title.
Yeah, you're very catchy, Scott. Wow.
We're gonna get into more about what that actually means, crash proofing our portfolio, but maybe more importantly, crash proofing our mindset when a crash inevitably comes. This idea popped up. Like, I don't read newspapers or follow the news media online, but I do spend some time on YouTube, and the things that get fed into my algorithm, I often see YouTube videos on like the crash is coming, the crash is always coming, isn't it?
Yeah, it's always coming.
Always coming.
And there's always a new time. And whatever the flavor du jour is, like, it's always, this time it's different.
That's right.
It's always the same, but it's always different.
For sure. As of late.
Yeah, what are you hearing as of late about the world, the economy, the financial markets? What's out there?
I think a few that come to mind is, it happened, this is probably a very common one, is that whenever markets are at all-time highs, people are concerned that there should be a reason for me not to put money into the market right now because everything it's never been so expensive to essentially buy a piece of the market, that the companies around the world are overvalued. That'd be one thing that you're hearing quite often here over the last couple of months or even this last year.
Yeah, totally. Such an interesting thing. It's like, why would we not invest in a balanced, diversified portfolio that we believe in just because valuations are whatever they are? If you fundamentally have come to the decision to invest for the long term in a balanced, diversified portfolio, you should be doing that regardless of whether the markets are at all-time highs or all-time lows.
For sure.
Just do it, right?
I think if you're already invested, you may already be like in and invested and have that mindset. I see it maybe come up in situations where maybe you've recently come into some money, or you're like not an investor at all, and you have had some cash building up on the sidelines over the, who knows how long, maybe the last year or two, and you've been waiting to get into the market, but maybe you've been told by a friend of a friend that the market's at a all-time high and maybe a crash is on the horizon, so you're just going to wait for that crash to happen before you maybe throw a bunch of money into the market.
Yeah, I mean, fair. Like, take every decision with caution and due diligence. But again, I go back to if you have the fundamental belief that investing in real companies across the world in a variety of different countries and different facets of the economy, if you believe in that, you should just go and do that, right?
For sure.
But it's so hard because I completely hear what you're saying, and I've seen it before. The news media love to talk about the downside, the negative, right? Like, there's a crash coming. You should be careful or sell or don't buy, whatever they're trying to spin that day. It's very
and you factor in a few other things that have been in the news of the last handful of months or the last year or so. Geopolitical tensions with Canada, US, and Trump, and the trade wars, the ongoing rise of AI, and now we're in talks that we might be in some sort of AI bubble, right? It's just another thing that we're told that we need to be worrying about, right?
Yeah. So do we need to worry about it?
We're going to get into why you probably shouldn't worry about it, but I think we have to talk about when we're talking on the topic of crashes. I think it would be important to start with, let's just talk about what a market crash is and how normal they actually are. Good place to start?
Yeah, good place to start. So let's kind of try to label what we mean by correction or a crash or a bear market, as they say, even.
Yeah, these might be new terms, right?
Yeah, totally. These are terms that maybe everyone interprets differently as well, right? So
yep.
When we talk about a correction, like in my understanding of it is like we're talking about like a 10% or more decline as being a market correction.
Yeah.
Is that how you would come to understand it too, Scott, or how would you describe that?
Yeah, I think a correction, which typically based on history, at least once a year on average, there's at least a correction of 10%, if not more, on an annual basis. Doesn't necessarily mean that on the given year as a whole that the market will be down, but at some point during the year, there could be what's called or considered a correction in the market for a period of time.
Yeah. Yeah, very good point. It's like it happens in a period of time. Doesn't mean the year ended as 10% down. It's just like at some point during that 12-month period, there was one point in time at least where the overall markets, let's say, call it the S&P 500 or whatever market index we're talking about, went down 10% or more.
Yep.
Yeah.
And then once you reach a 20% or more decline, whether it's for a short period of time or a longer period of time, once we hit that point where it's 20% or more of a decrease, that's considered a bear market, at least from a definition standpoint.
Yeah. I always hated those terms, bull and bear market. Like, why do we need to use those? Like, I don't know.
Are you telling me you don't have like a little figurine on your desk, Chris, of like a bull and a bear?
No.
I've seen posters behind some financial advisors, like the bull and the bear.
Yeah.
With graphs and charts. We need some of those in our life. Get rid of this blue wall.
I think I have a bear that Bradley, my son, drew for me.
Here you go. Nice.
Oh, that's Santa. Sorry. That's Santa.
Christmas bear.
Yeah, that's right. So how often have bear markets happened over, I guess, like the measurable history that we have of like something like the S&P 500?
To put in perspective in terms of how normal crashes or a bear market, how often that occurs, since 1928, the S&P 500, again, that's the largest 500 companies in the United States, the S&P 500 has experienced 26 bear markets over that roughly 100-year period of time. So that works out to, on average, every 3 to 4 years, we see some sort of bear market in the range of a 20% or more pullback in the broader market, whether that be the S&P 500 or like you said, the broader global market.
Interesting. I find that so fascinating that like this has historically happened on average every 3 to 4 years, but every time that I've been involved or experienced or witnessed a bear market, which is not that many, to be fair. Like we're talking COVID and 2008. Those are really the only two that I've been through personally. But every time, what I've noticed in the books I've read and what I've learned is like every time there is a bear market, a crash like that, it always feels like it's different. It's unprecedented. It's never happened before. And there's always this underlying theme of like the world's ending. It's over. Like we've never seen this before. This time it's different. You should change your investment philosophy because this time it's different.
For sure. The next one will be different.
It will be.
The next time we go through a bear market, it's not going to be for the same reason we did in 2020 or back in 2008 or whatever point in time that you want to look back at history.
Yeah. But the fact that like we've gone through 25 or so of these bear markets in the last 100 years. So there's been 25 times where the market S&P 500 has crashed by 20% or more over some short period of time. And yet here we are at all-time highs. And if you look back over that same period of time, the S&P 500 has probably returned somewhere in the neighborhood of 9% on average, annualized, right?
Yeah, for sure. I think the biggest thing that I always think back on when it comes to bear markets and the mindset around that is that it comes back to like, do you have faith in the future? Do you have faith that we as humanity, those of us that run businesses around the world will continue to show up at our businesses and provide that good or service to the people that we provide them to and generate a profit?
And as a shareholder, you're rewarded for that profit of the companies you're invested in, right?
Exactly.
Yeah. So bottom line here is crashes are normal. We should expect corrections. We should expect crashes or bear markets. And if you're going to invest in the market, which we think everyone should be invested in financial markets, you probably should be going into that with a long-term horizon in mind, like thinking about 20, 30, 40 years even down the road, your future self. That's what we're investing for. We should go into that expecting to see 10 to 12 bear markets over our lifetime as an investor.
For sure. Sounds like you've been through two. So you got a number to go.
I got 10 more to go.
At least.
Let's go.
Yeah, for sure. That's assuming that the average stays to its norm, but
yeah, could be more, could be less, right?
That's right. And what's interesting too is that that's just the average time frame. Like every 3 to 4 years, we see a bear market, but there's also been periods of time where, maybe there's a 6 or 7 or 8 year period between the previous bear market and where we currently stand. Generally, we're at a point of all-time highs. And then the news media will say, it's been too long. We're overdue. Markets at all-time highs. Like we're long overdue for one. So something to keep in mind too when we're thinking about how often they occur.
And I think all of this comes back to like the underlying fundamentals of investing. Yes, you need to have a good, low-cost, balanced, diversified portfolio. That is absolutely essential. But I think the emphasis on that pales in comparison to the psychology of you, the investor.
Yep.
Right. So yeah, I think it's probably fair to say like 90% of your long-term investment success is going to come down to your behavior. It's more of a psychology thing than it is a fundamentals, financial, choice of funds, etc.
So as we shift gears, I think a better question that we should ask ourselves is not when will Tamagotchi needs me. I don't know what's going on with Tamagotchi, but it'll have to wait. Where was I? A better question to ask is not when will the crash come, but rather, am I positioned to weather the crash when it inevitably comes?
Yeah.
Would you agree?
Yeah, I totally agree. I think so often we are led to ask that question of like, when's the next crash coming? That's what we're trying to find out. And I think, you totally agree. That's not the right question to ask. The question is, are we positioned to weather that crash? Because it is coming at some point. So this is where our 4 pillars come in of kind of investment fundamentals. Like how do we prepare? How do we make sure that we are positioned well to weather it?
Number 1 comes down to diversification, right? We've all heard the saying, don't put all your eggs in one basket. I think we often underestimate when I'm thinking about chiropractors is that they're already taking on risk and concentration with the business that they own. And oftentimes as well with potentially their principal residence, maybe a rental property that they might have. There's a lot of concentration in those assets, just as individual assets. When you're looking to grow your wealth beyond your business and the real estate that you own, where would you go? Where do you go from there?
Yeah, a globally diversified portfolio is absolutely where we should be looking to go to get into a portfolio that owns 15, 16,000 different companies across the globe that are in different sectors and geographies. That's going to significantly decrease your risk of owning one business at one location, one industry.
Mm-hmm.
Makes sense, right?
Yeah.
And that's not to understate the importance of growing a strong practice and investing in your business. Absolutely. That is like fundamentally, that is going to be a huge driver of your personal wealth. If you're a chiropractic, practice owner, we're not trying to say that there's anything inherently wrong with that. That's great. And it's going to drive your wealth accumulation. But we often see where, practice owners specifically can get into this position where they don't have that balance, the globally diversified balance of like an investment portfolio when all of their assets are in that one asset class, their practice.
For sure. Because when we think about diversification in a globally diversified portfolio, what that really means is that we're lowering the volatility. Like when you look at an individual stock, even if it's just your business, there's no one measuring the volatility of the value of your chiropractic business. But let's take a company like, let's say Tesla, for example. There's been some volatility in the past with the valuation of Tesla stock. There could be a wide range in terms of any given year, that kind of roller coaster ride of the valuation of Tesla. But then if you add if you put in and layer in an additional 15,000 companies with the addition of Tesla, that inherently lowers the broad volatility across owning so many different companies from around the world.
Totally.
Right. And I like to bring up this example too, and outside of just your business, but when we even think about your principal residence, your property that you may live in, there's volatility with that as well. There's just not a great mechanism out there to allow us to understand the daily volatility of the valuation of our home.
Yeah.
Because it's not easy to say, oh, something's happened. I'm going to easily transact and sell my home because of some volatility. And now my home is because my home's worth 20% less, right? We're naturally inclined to hold on to that asset because of just the nature of real estate.
Yeah. Yeah. And it's a place to live first and foremost. It's like, we're not going to just leave. Not just going to change where we want to live because it's the property value changed.
For sure. But the same goes even if you had a rental property, right? You're less likely just to quickly sell a rental property because the valuation is that you may not even be aware of is down by a certain percentage point.
I think that same like sentiment or like psychological approach is kind of what I was mentioning earlier about, you shouldn't care what the valuation of the market is. If you believe in investing for the long term in a balanced and diversified, globally balanced, diversified portfolio, you should just go and do that. Just like owning a house. Like if you want to own a house, there's a lot of reasons that you might want to do that. You should go and do that. And it shouldn't be driven solely on the valuation.
Yeah, I agree.
Interesting stat I see you put down here, Scott, that over the last 100 years, there have been 75 positive years for the S&P 500.
Yeah, the reason why I added that stat to the show sheet here is that I think it's naturally fairly common for us to think that holding cash doesn't carry any risk. Tell our listeners why holding cash does carry risk.
Yeah, inflation, you're losing purchasing power over time, right? So if we had inflation at like 3%, every 24 years, the value of your cash is going to be cut in half. That's a huge risk.
It's a risk that we don't give enough. Like we think cash is, the old saying, cash is king, cash is safe, but there is a risk of inflation to erode the purchasing power of that dollar. But when we zoom out over a long enough time horizon, like we're looking here, 100 years, the S&P 500 has positive years 75% of the time. And I believe the stat is there's never been a 20-year rolling period over the last 100 years either that you've lost or had a negative return over that 20-year period of time.
Yeah.
So theoretically, it's actually riskier to hold cash over, say, a 20-year period of time than it is to own a globally diversified portfolio over a 20-year period of time, right? Yeah. The difference there is the volatility and what you actually experience, which all ties into generally speaking, our behavior and our psychology around the decisions that we make and how we react to the news and volatility of the market.
Not for sure. And it's okay. So you mentioned like the S&P has never had a negative 20-year period over the last 100 years. That kind of goes into our next pillar. First one is diversification. Secondly is time horizon. We need to stay invested, right? So markets are always going to recover given enough time. That's what history shows us. And obviously there's going to be scary moments, but if we can stick to our investment strategy and stay invested, that is going to have the best outcome for us as investors.
Mm-hmm. If you think about going back to the point of, say, an example of someone that's maybe new to investing and sitting on cash, or maybe they're an investor and has some cash on the sidelines, they're waiting to put that into the market. We talked about this, and I think on previous episodes around like missing some of the best days in the market can have a really catastrophic effect on the return that you actually will receive over the long term. So if you're in your 30s, 40s, even 50s for that matter, sitting on cash and you still have time horizon in front of you, you're likely without the ability to have that 20/20 hindsight of what the markets did. You're better off just getting invested. You're in it for the long term. Right?
For sure. Yeah. And I think that like when we reflect on time horizon specifically, like staying invested, staying in the game, as you say, like the key takeaway on this point for our listeners is that we shouldn't really care about what the return was in 2025 or what it's going to be in 2026. We shouldn't get too excited about all the ups, and we shouldn't get too excited about the potential downs and the downs that do come. much more importantly is just to maintain that investment and that discipline over the years. Let's go on to the third strategy, our third pillar here, which I think is best described as just keep buying, keep investing,
Just
no matter
keep
what.
buying.
Keep on buying. There's a book.
High or low, there is a book. It's a great book.
Yeah.
Don't ask me.
Nick-
Just
Nick
Keep Buying
McGilly.
by Nick McGilly. Might have butchered
of
the
the-
last name there.
Friend of the show, but we don't know how to say your last name, Nick. Sorry.
Close friend of the show. Close friend for sure. Mm-hmm.
All right. So
Yeah.
this could be best described as like dollar cost averaging or investing every month, regardless of what the markets do. That's just a fancy way. Like dollar cost averaging is maybe the financial term that we've coined, but the industry has coined. But for all of our listeners that, are maybe newer to investing, simply just automating a monthly investment, an amount that gets invested every month, no matter what. And through doing that and having that mechanism happen, you're naturally going to buy more shares of the units, the investments that you're buying when prices are low. So you're going to buy more units when prices are low, and you're going to buy less units when prices are high. So the dollar cost of those shares is going to average out over time, right?
That's right. Yep.
You got an analogy you like to give. Share that.
I've been sharing this one for a number of years. When you think of Apple never goes on sale. Like you walk into an Apple store and there's never a sale. This is the price. If you want to buy a MacBook Pro or an iPhone 17, this is the price. But there has been periods of time where Apple stock has gone down from a crash bear market where their stock has gone down 15, 20, 30%. Let me ask you, Chris, if a MacBook Pro, not that you're an Apple guy, you're a PC guy. We're trying to fix this problem here within the business, but
there's no problem.
Maybe it would actually happen, if this to this point, if an Apple MacBook were to go on sale, they're usually what, $2,500? If it was 30% off, would you buy a MacBook, or you'd be like, oh, I gotta give a second guessing here?
What I would do, Scott, is I would buy 10 and then I would resell them at market value.
That's right. You'd wait for the sale to end, the price to come back to normal, and sell them. But we also say that you hold forever though too, right? So you might be stuck holding those 10 MacBook Pros,
but not MacBooks, not in this case. Yeah, that's the only reason I would sell. Now, if Apple stock went on sale by 30%, I would absolutely buy more Apple stock and hold that indefinitely.
For sure. Yeah, it's the psychology around that is that when we actually see the tangible product on sale, we say that's a great deal. I'm going to buy that. But when it comes to the stock price of a company that has fallen by 30%,
or the market in general,
yeah, of course,
a market crash of 30% means everything's on sale by 30% compared to what it used to be. Yeah. And
I think a lot of investors do realize that this is it's an opportunity, but there's also an equal amount of investors that say, is it going to get worse? I'm just going to wait till things recover. And that's where we go back to by just waiting on the sidelines and not getting in at any point in time, you might miss some of those best days in the market. Yeah. So you're best off just keep buying month over month. Doesn't matter what the price is.
The outcome here, we're not trying to suggest that anyone should be trying to time the market or, buy more when things do go on sale. But instead, what we're trying to suggest is that when the market does correct, does go down, is in a bear market, it's nothing to be fearful of. It's actually a great opportunity to continue investing the way you always have and stick to that strategy. Yeah.
And if you're lucky and you have randomly fallen into an inheritance or some cash during a big market pullback, great time to get that money into the market. Great opportunity, right?
But even at that, I think I'm thinking of a couple of Rational Reminder episodes where Ben Felix goes through talking about lump sum, like in that exact example you gave, like someone gets an inheritance. Like, are they better off to lump sum invest or to dollar cost average that over a period of time? And statistically, it's actually better off to lump sum invest that inheritance rather than dollar cost average. That doesn't mean it's the right answer, because it might be really hard to stick to that strategy from a psychological perspective. So regardless, the answer is get the money into the market in whatever way you're comfortable with.
That's right.
And then once we already are invested, there's something that we can do to kind of systematically take advantage of, when things change in value. Talk us through that, Scott.
Yeah. So the next pillar is what's referred to as rebalancing. So another industry term, but what rebalancing basically means is that you're going to have various asset classes in your portfolio potentially. You might own a basket of US companies, a basket of Canadian companies, global companies, for example. Over any given period of time, not uncommon for some areas of the world to outperform other areas. For example, like walk us through what happened in 2025 between Canada and the US, Chris.
2025 was a great year for Canada, not so great for the US. I mean, it was okay for the US, but it wasn't as strong as
Still a strong year.
as the
Yep.
Canadian market. So
For
what
sure.
would happen is, let's just say you have a balanced, portfolio of 30% Canada, 30% US, 20% international equities, and then 20% bonds. So we have 80% in equities, 20% in fixed income and bonds. Your Canadian assets have gone up in value more so than the US. So now your allocation towards Canada has gone from 30% maybe up to 33%. But what we want to do is rebalance that, because we don't want our Canadian assets to become more than 30% of the portfolio. We've decided at our initial kind of portfolio construction that that's the portfolio we want, right? We don't want too much exposure to Canada because we know it's only a small percentage of the global market, about 2%. So we don't want to get too highly invested in Canada. So by selling a little bit of the Canadian fund and splitting that between other funds that need to restore that equal 30, 30, 20, 20 balance between everything, that's essentially how rebalancing can work.
Tell us why, though. Why is that hard from a psychological behavior standpoint?
So hard, because who wants to sell something that's gone up in value? It's going to keep going up in value, isn't it, Scott?
That's right. You have to sell something in your portfolio that has been doing really well over a certain period of time, say it's been a year, and go take that cash that you've sold some of that hot part of your portfolio and go buy a piece that hasn't been performing as well.
Yeah, so super hard in principle to execute this, with the right discipline. Like a self-directed investor might be able to do this, if they have like a written investment mandate, which I think everyone should have if you're managing your portfolio yourself. But for the rest of us, like, there are mechanisms that we can have in place that allow the portfolio to be rebalanced essentially systematically without having to go through the psychological like push and pull of like, oh, it hurts to sell that at like, what if it keeps going up? And like, I don't really want to buy bonds that are haven't done so good over the last 3 years. It takes away that psychological burden.
Yeah, for sure.
Yeah.
All right. At the 11th hour, we added in a bonus fifth pillar, thanks to Chris. So Chris, what's our extra pillar here that we want to add to the conversation?
Yeah, I think one of the most important things with all of this talk about, crash proofing your portfolio or being able to ride out whatever happens in the markets is we have to be able to stick to our investment plan. And so the fifth pillar is take less risk if you need to. I would say it's 100% better to be in a less risky portfolio, say something that's 60% equities and 40% fixed income or bonds, versus maybe an 80-20 or 100% equity portfolio if you can't stick with that during the hard times. And if you've never been through market correction, if you're new to investing, it's probably better to start off a little more conservative and go into a higher risk portfolio over time once you have that experience of going through the inevitable ups and downs of the market.
So your typical 80% equities, 20% fixed income, that's kind of considered a growth portfolio. If you're invested in that, you have been for a while, and you go through a major bear market, a crash, and you ride through that and you say, I didn't lose any sleep. I actually viewed that as an opportunity and continued to dollar cost average and maybe threw in some extra cash if I had it. That might be a sign to say maybe you would be in a good position to take on more volatility by moving to a 100% equity portfolio. On the contrary, though, I know Tamagotchi. But on the flip side, if you're in an 80-20 portfolio, you go through a major crash and you still can't, like, it's just stressing you out. You feel like you need to do something, you need to sell out to cash, can't take the losses or any more bleeding. That was a sign that you were in the wrong portfolio to begin with, right? And that's okay to recognize that and say, hey, I need to shift this down to a 60-40 with the big kind of asterisks here to say, You shift into a 60-40, likely not a good reason to say, all right, when the market kind of recovers, I'm going to move back into an 80-20 portfolio.
Yeah, I would say if we had a client that wanted to do that, we would be strongly advising against going back to the 80-20 portfolio when markets are feeling good, right?
For sure.
Yeah.
All right, let's wrap up with a few great quotes, mindset shifts from some of the greats.
Yeah.
Why don't you hit the first one?
Warren Buffett,
Friend
one
of
of
the
the best. Friend of the show, of course. He has a famous quote that says, "The stock market is a device for transferring money or wealth from the inpatient to the patient." So, I mean, so powerful, but I mean, we've come to learn this through our own experience of being long-term investors. And I think a lot of the clients are with us on that journey as well. But patience is your number one friend as an investor.
That's right. Yeah.
What's next?
If you're globally diversified, it's not going to be overly exciting. Like it's just,
There's nothing sexy about it.
There's nothing sexy about it. It's not, it shouldn't be a source of entertainment. Let's put it that way.
Yeah,
right.
For sure.
All right. Next one here that we wanted to touch on. We've brought up Morgan Housel's name on the show in previous episodes. He has such a great saying that we had to share. He says this: market returns aren't free. Volatility is the fee you pay for long-term returns, not a fine you pay for doing something wrong. So he says, here's the difference. A fee is something you willingly pay for a service you value. On the contrary, a fine is punishment for doing something wrong, right? So I think it's very normal when we have negative volatility in the broad markets, we might think the following, did my advisor make a mistake? Did I do something wrong? Should I have been doing something better? Should I be smarter or more careful when it comes to my portfolio? Or maybe, worst case scenario, is this an opportunity for us to get out before it gets worse, right? So no, the volatility that you experience in your portfolio is just the admission for higher returns. And ideally, you've been coached and knew this was going to be part of the deal when you started the process or started the journey on being a long-term investor.
Yeah, if you're working with an advisor and they haven't talked to you about market crashes being inevitable and being part of what you're going to have to go through, probably missing the mark somewhere there. Yeah.
So action items, Chris, what are a few things that we can leave our listeners with in terms of, next steps? What should they be thinking about or taking action on?
Well, I think, for more seasoned investors that currently invested already, maybe it's time to review your asset allocation. Does it still match with your timeline and your tolerance for risk and your capacity to take risk? Are you comfortable with the amount of risk that you're currently taking with your allocation? Another one is, I mentioned earlier, is like, do you have an investment policy statement? And is it something that you can, it's written down? It's not just something in your head. It's like, we have this is our mandate. This is what we're trying to execute. And when the markets get scary, we can review that and remind ourselves of what we're trying to do. And then lastly, I think working with an advisor, having someone on your team is just so invaluable. Like the behavioral coaching that happens in our client relationships, it's so impactful. And it's not just when markets are good or markets are bad, but it's always, but especially when markets are down. Like even the most experienced investor that has their emotions in check and understands that they've been through it before, we all get scared when market corrections happen. And having somebody that you know and trust, that knows your life, your financial life, and can continue to support you through those scary moments is invaluable.
Mm-hmm. It makes me think of a really great sketch that Carl Richards has. So envision this: white sheet of paper. On one side, you have yourself. And on the other side, you have the big mistake. And in the middle, envision a pillar. And on that pillar, that says your advisor. And maybe for an asterisk here, it doesn't necessarily need to be an advisor, but that advisor symbolizes what you need to have between you and that potential catastrophic mistake of making a poor behavior decision when the markets get scary.
Totally. So invaluable. All right, let's sum it up, Scott. The best crash-proof strategy isn't avoiding crashes. It's actually building a portfolio and the right mindset that can help you withstand the crashes that are coming.
I love it. We'll wrap it there. I think it was a great conversation. Like we said, we don't know when the next crash is going to come. For all we know, we could post this episode tomorrow and it could be the next day.
Yeah.
Could be.
Could
Or the alternative is that we see another really strong year in the market. Who knows, right? We'll see what happens. But all that being said, time in the market is so much more important than timing the market. So if you're a long-term investor, stay the course. Thanks for listening. We'll see you next week.
All opinions expressed on the Chiro Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.